Coming up in today's show, stocks trade mixed as bond yields fall, along with crude oil. I give you an update on the latest developments in the Middle East. Jeremy Siegel says stocks are a buying opportunity. Bill Ackman closes his US Treasury short position. Bitcoin rallies above $30,000. And we'll take a look at Q3 earnings seasons. I've got a good one for you guys. Let's go. Welcome back to the Click Capital Daily Market Show, everybody. Hope you had a great weekend. My name's Jared. I'm going to get you up to speed on all the latest financial news, data, and charts. And stick with me today because I've got a good one for you. There's a lot going on out there at the moment. And to start the week off, a lot of the market was down except for the NASDAQ. Again, it was mega cap tech trading different from the pack, led by NVDA up almost 4%. And there were a few other spots of green out there, the defense contractors, with a bit of red in the healthcare and energy stocks with a bit of a pullback in crude today. So just a bit of an update out of the Middle East on the latest on the conflict between Israel and Hamas. Israel is still conducting an intense aerial bombing of the Gaza Strip, with US and European leaders urging Israel to hold off on a Gaza invasion while they try and negotiate the release of hostages there. And so Israel is holding back on that as much as they would like to go in. However, that's what helped oil and gold fall back a bit today. So we do have a little bit of fighting coming out of Hezbollah in Lebanon, and some small little skirmishes out of Syria. However, things are mostly contained. However, they could still spill over and escalate into a full-blown Middle East war. And we've got China and Russia sending more military assets to the region as well, as they try and gain seats at the table in the Middle East and influence the outcome of whatever happens over there. And the US, who was quick to gain the first mover advantage in the Middle East, is also sending more military assets over there in a deterrence of further escalation, but also in preparation if things do spill over. And the US could still very well get involved in this, especially if Hezbollah step up things. The US military has already warned that they will respond directly to that. And there's escalating tensions in the South China Sea as well, after the US also warned China it will defend the Philippines after China ships ram vessels in Manila. So China, Russia, and Iran very much want to dethrone the US as the world's superpower, and they're already trying to work together to broker a two-state solution for Israel and the Palestinians. And their goal is to get things done outside the US, and they could also get involved militarily as well. So they also want to say in what's going on over there. And that's why it has the ingredients to boil over a bit further. Which if it did, in the worst case, we could still see oil soar to $150 a barrel and rock global financial markets if this does spill over into a full-blown Middle Eastern war, with the US and Iran getting involved, along with all the other Islamic extremist militant groups. However, for now it's contained and there's still a pathway to a peaceful solution. And we've got crude pulling back a bit today, down 2.9% to $85 a barrel. And same deal with gold after we got a little bit technically overbought last week. That did a much softer pullback today, back below $2,000 an ounce. And you can see it's really the gold market that's had the reaction to what's going on in the Middle East. And just looking at the S&P 500 today, we initially gapped down first thing in the morning. After initially gapping down, it sold off for a bit, then found support, then actually rallied back up to early afternoon before peeling back a little bit. And so I put in a bit of a spinning doji here. And stick with me because I'll come back to this later on the charts and give you my thoughts on where we are technically. First, we'll just keep moving through some research and news today. And we've still got a lot of bulls out there, with one strategist saying stocks have room to rally 14% this year, with them saying a lot of indicators are pointing that the S&P 500 is oversold. They're going to say you're getting a lot of bad stuff out of the way. The market is already sold off to a degree here, but I think once we get some clarity brought into what's going to happen in Washington, get through the earnings seasons, these kind of things, I think there's a real meaningful pop. That's a similar sentiment echoed by the always colourful Wharton professor Jeremy Siegel, who says rising geopolitical risks represent a buying opportunity and investors should favour stocks over bonds. He said stocks climb the wall of worry when there's no cloud in the sky, you're buying too high. He goes on to say, I think the promise of AI is real. This year our growth has been driven by productivity. Productivity-driven growth brings inflation down. It's good for earnings, but it does drive yields up. Higher real growth, more borrowing, more capital investment. I want to be in stocks and not bonds. However, on the other side of the coin, we've got the former bond king, Bill Gross. He expects a US recession to begin by year's end. He went on to say regional bank carnage and the recent rise in auto delinquencies to long-term historical highs indicate US economy is slowing significantly, recession coming in the fourth quarter. And the last year has seen a pretty big change in financial markets, with some saying the bond market has entered a new world, rewriting their rules on what drives yields higher, as it was previously central banks that were the top buyers of bonds. But as we know, many have shifted to quantitative tightening and trying to reduce their balance sheets by letting those bonds mature and fall off. And we're actually seeing many investors, small and large portfolio managers, starting to buy bond ETFs now. As for the first time in many years, we can easily earn above 5%. Large investment manager Invesco has even seen rising demand from hedge funds and other institutional investors, such as mutual funds and insurance companies, for ETFs that provide exposure to the bond market. And billionaire hedge fund manager Bill Ackman, who is probably in the top 10 people in the world who can really influence markets when he speaks, came out a couple of months ago and was spooking everyone with how much yields could run away. And after that, the 10-year did start running to the upside. And of course, he was short treasuries. However, he's just come out today saying he's closed his short position, citing too much risk in the world to be betting against treasuries. He went on to say the economy is slowing faster than recent data suggests, and he was specifically betting against a 30-year treasury bond. And when he first came out and warned us all of higher yields, the 30-year was at 4.17, and today we got up a full percentage point higher, 5.18. So that was a really profitable short trade for him. And he's probably also looking at what's going on in the Middle East. If that spills over, there will be a bit of a flight to safety in treasuries. And just looking at the most popular bond ETF on the market, TLT, that is still trying to find a bottom here, finishing the day up 1.2% on big volume again, and my DSI indicator is showing a divergence. And my dark pool indicator, which I recently just updated and renamed to institutional buying percentage, has actually been showing a lot of accumulation over the last couple of weeks here, and this is deep technically oversold. So it looks like the bond market is already in the process of trying to find a bottom here. However, just looking at the 10-year yield, that's not too much of a convincing topping process. I think it's still potential we see a blow off top. However, things would have to really cool down in the Middle East for that to happen. We also just got news out of another monster corporate transaction in the oil business. Just after a couple of weeks ago, we saw Exxon swallow Pioneer Natural Resources and a bet on US oil production. We're now seeing the second largest oil producer, Chevron, come out in a similar deal, buying Hess Corp for $53 billion. That was just a little bit below what Exxon paid for Pioneer, $60 billion. And to get that deal done, Chevron's offered 1.025 of its shares for each Hess share held, which works out to be about $171 a share. Market wasn't too warm to that idea, actually selling off Chevron 3.6% today, which is normal price action in a merger. And we've all been watching those snack food maker stocks getting hammered these last couple of months. Now we've got Wall Street coming out forecasting anti-obesity drug sales to hit $100 billion by the end of the decade. And so we might be reaching peak average calorie consumption in society at the moment. And it's usually those cheap, convenient, sugary snacks that add on the extra calories in between meals. And we can see some of the makers of those appetite-suppressing drugs like Eli Lilly doing really well the last couple of months. Whilst on the other side of that story, snack makers like Mondelez, Pepsi, Coca-Cola, and Nestle have all been getting hammered. So whilst it's not materially affecting profits right now, the market's a forward-looking pricing mechanism and doesn't like the potential effects of these obesity drugs on these snack makers. But of course, there's other factors at play here, including inflation and just the price of food in general. We're also getting more rumors and news that a Bitcoin ETF has been approved and is just about to come through. That's why we've got the cryptocurrency rocketing up today above $30,000. And Gary Gensler and the SEC has been trying to fight this one. However, they have been losing that fight, and it looks like the industry may win in the end. You can see that in the price action of Bitcoin today, trading really strong, holding above $31,000 a coin, and now sitting right at the top of this resistance level, just taking you out to a weekly chart. It's been choked up between the support and resistance most of the year in pretty much a sideways market. However, it looks like it could be breaking out here with a bit of excitement going into a Bitcoin ETF. And one of my old economy stock favorites, Walgreens, got an upgrade from JP Morgan today, saying with the new CEO they could be entering a new era as they try and evolve their company into a full-on healthcare company, not just a retail convenience store. Market seemed to like that a little bit today, up 3.2%. Still a lot of technical signs that we're bottoming down here. Big divergence on both my DSI and hidden divergence indicators. And just taking you out to a monthly chart, we can see how much that's been beaten down pretty much for 8 years now. So this has got the makings of a potentially really good turnaround story. And if management are able to pull it off, then we could easily see $50 a share over the next couple of years, making for a good risk reward at current levels. So we're just getting into the thicker Q3 earnings season this week. Bunch of mega cap tech about to report that we'll be keeping an eye on, and I'll let you know what's going to happen. So far, it's doing okay. We've had about 17% of S&P 500 companies report so far. 73% of them have reported EPS surprise, which is a little bit below long-term average around 77% and a bit more below as well, with revenue 66% coming in with a beat. And so far, the earnings for the S&P 500 as a whole is down 0.4%, which is pretty much in line with what analysts were expected for this quarter. They're expecting pretty much flat, maybe a little bit soft. Then they're expecting growth to come back in Q4 and into next year as well. So even though the bond market, Fed fund futures are predicting in a recession, the stock market and equity analysts are definitely not, as they think earnings are going to grow back up to 12% next year. And we've currently got the forward PE on the S&P 500 about 17.7, which is sitting around long-term averages. So over to economic data, we didn't get much to start off the week. Got some Japanese PMIs coming in soon. We just had some Aussie PMIs, manufacturing and services, coming in a little bit weaker than expected. Then we got some more PMIs out of the Eurozone tomorrow and America, and some inflation CPI data with Australia. Into Wednesday, we'll get the interest rate decision from the Bank of Canada, along with a bunch of central bank speakers. Thursday, we'll get some GDP data from the States, along with jobless claims. Then finishing out the week, we'll get some PCE, personal income spending data from the States. Fed fund futures still pretty much the same. About a 1 in 3 chance the Fed will hike in January. And the market's still a little nervous here. Fear and greed index at 27. Corporate insiders not doing much trading at all, both purchasing and selling stock. And just looking at my custom indicators on the S&P 500, we've got my institutional buying indicator in the neutral zone at 49%. However, the S&P 500 oscillator has just slipped under the oversold level at 39.4. So the market is getting a bit oversold here. We could be in for a little bit of a bounce, but it's still on loose ground in my opinion. And stick with me because I'll come back to the main US indices at the end of this video like I do every day. First, let's just quickly move through all other financial markets and have a look at what's going on out there. There's Canada's TSX, right back down to support. UK FTSE coming off, along with the German DAX on a bit of a hammer formation. China market's flat, and the Nikkei's found some support, and the Aussie looking to find support as well. VIX actually got up a bit above 23 today, but finished the day 6% lower, still holding above that 20 level. And the options market getting a little bit excited again today. Almost 38 million contracts traded, 52% of them calls, and we can see in the put-call ratios getting back down there to 0.84. Breadth is still pretty weak here. We've only got 13% of stocks above the 50-day average. And another day of really significant weakening breadth in the amount of new lows versus new highs. Actually breaking out on the NASDAQ, 264 new lows versus 7 new highs. But those mega cap tech are helping to hold the indices up. We can see that in the growth versus value spread, and there's a look at gold versus treasuries. Definitely technically overbought up here, and the flight to safety trade, and a little bit of a pullback in inflation expectations today. There's short-term rates pulling back a bit. Still got the 2-year above 5%. There's the 10-year at 4.84 and the 30-year just holding at 5%. High-yield bonds trying to hold on and put in a low there. And a little bit of a pullback in the dollar with yields. Now back down below the 50-day VWAP. And a bit of a pullback in commodities overall with gold and crude pulling back. Although we've still got some food commodities like sugar trading near highs. And over to stock sectors, even though we had a bunch of sectors more on the growth side finish higher today. Just looking at my sector trends table indicator, every single sector is below the 5-day moving average, and most of them are below the 20-day, all except oil, gas, communications, and gold miners. So still a lot of downward momentum out there. Cannabis ETF pulling back further, now getting back down to this support zone. And it was biotech, the losing sector today, which has been really weak these last couple of months, falling another 2%. It was actually meme stocks the winner today, up 1%. A little bit of pullbacks in energy, oil and gas. Transport's breaking down to new lows, along with industrials. REITs found lower lows, and then we've got healthcare coming back down to the support. Consumer staples actually building a pretty good bullish divergence here, and a little bit in utilities as well. Over to stocks, we saw JP Morgan break down a little bit today. And there's the big guys. Apple, after actually gapping down and finding $170 a share, held on pretty good to finish the day flat, and pretty much similar price action in Microsoft, who we've got reporting earnings tomorrow. Same deal with Google, which has been holding up the best out of the pack. Amazon in a couple of days. NVDA is still about a month away, but is trying to find support. We've been looking at this head and shoulders pattern, but we really need to close below the neckline, those low 400s to confirm that. And Tesla actually found lows today at $202 a share, but like the market, managed to recover and put in a bit of a spinning doji. So it looks like it's trying to find support here. And Netflix looks to be defending its earnings gap from last week. A few mixed moves in the meme space. There's some of those defense contractors holding up pretty good. Israel stocks are still sliding lower. Bit of a gap down in Saudi Arabia stocks as well today. And there's General Motors still really weak. Trying to find a bottom here. We'll hear from earnings from them tomorrow as well. Along with 3M, which found new lows. They got earnings coming out tomorrow. And Verizon, another old economy stock I'm keeping an eye on. And the banks still look a little weak here. Some of them actually breaking down, like Charles Schwab finishing on the lows down 3%. sentiment after actually having a good earnings last week. Okay, so there we are in the S&P 500, just holding above 4,200. Like I said, we've got that big support zone around that 4,100 level. And the real standout today was mega cap tech, with the Nasdaq actually finishing higher. And like a lot of charts I've just shown you, it's trying to find support around here. We do have some divergences building, with some indicators saying we could be near a tradable low. So we could get a bounce from these levels. However, I think it's still on shaky ground. Things in the Middle East could still spill over, which would send crude higher. And the equity market's really hanging its hat on this 10-year yield pulling back a bit. So that's another big influencing factor at play at the moment. Other than that, we've got a bunch of earnings coming out this week, which could sway the market, and we'll see what that brings us. Thanks very much for watching the Click Capital Daily Market Show, and I'll see all you guys again tomorrow afternoon with some earnings reports. Cheers.